traders to Even I Can Trade, where we show you how to build wealth, actual, true wealth, live, one step at a time.
What's up, guys? Just playing around. Anyway, it's the weekend of January 7th. And if you don't know me, I am obsessed with spreadsheets. And I don't know why, but once I get my hands on tinkering with a spreadsheet, I just can't stop. So I kind of made a couple spreadsheets. Let's start out tinkering with this other spreadsheet that you guys saw, where we were trying to kind of show what the compounding effect of wealth is and when you should start saving and all that kind of stuff. And I realized a lot of my formulas were wrong. But the overall idea was right, but there's some stuff in here that I can't quite figure out. They got the numbers kind of wonky. But basically, it was under-reporting the growth that you would find in real life. So the numbers would be much bigger towards the end than what I showed. So I was trying to figure that out. And one thing led to another. And I decided to just kind of make a video on my overall trading strategy, like the rules, why I do what I do, why the SPX, why 0 DTE, what are the critical rules that are going through my head when I'm making a trade, all that kind of stuff. So I'm going to go through all of that. And also I made this other cool little sheet that I want to talk about first, actually, that I'm trying to make it so that it can help me decide what to trade on pretty quickly without having to do a whole bunch of math in my head and everything like that. So hopefully I'll just be able to look at this sheet when it's time to trade and be able to pick out my strikes without having to go to the calculator and, plus and minus and all this kind of stuff to figure out my strikes. Just save me a little bit of time, a little bit of headache for my trading. The good thing about Google Sheets is that you can pull in live market data. So that's pretty cool. So I'm trying to take advantage of that. So let's talk about this real quick and what I have. So what I've got is basically this section right here is telling me what strikes are going to be the next strikes up from 2 times the expected move, which is where I like to trade. I like to trade 2 times the expected move. So the idea is this right here is going to be the call spread strike. If I want to trade a call spread, it's telling me how far up it is from the current market, what percentage it is up from the current market, away from the current market, and the same thing on the put side. So I can come here if the market is way up and I'm seeing a good entry point for a call spread. I could just pop over here and say, 39.65. Let me go hunt for 39.65 and place the trade without having to do too much wrangling around. One Achilles heel is I can't pull in the expected move data. I have to manually enter that, but I am working on it as well. I'm trying to see if I can use the VIX, which I can pull in, if I can use the VIX to calculate what the expected move should be. So I kind of, back calculated the VIX and use the ratio to kind of get the expected move here and 2 times the expected move here using a specific ratio. So I'll have to see if the VIX, how correlated the VIX is to the expected move. Now, how the expected move is calculated, if you don't know, it's basically 85% of an at the money straddle. If you purchase a straddle, look at the total cost of that straddle, take 85% of that number. That's where the expected move comes from. And the straddle is definitely going to be affected by the VIX, but I don't know to what degree. And I don't know how corollary it is, to the final expected move number. So I'll see when the market opens if this number matches what the expected move is in Thinkorswim, then I might be onto something, and it'll kind of completely automate this little thing. But if that doesn't work, then I'm gonna just have to punch in the expected move number here manually, and then it'll spit out what my trade should be. So we've got that. And then this over here, this is if I want to adjust these numbers depending on where we are in the market and everything like that. These numbers tell me what is going to be up at a certain level, like what price the market will be if it goes up 2%, 2.5%, 3%, so on and so forth, and how many points away that number is from the current price. And then this number I really like. This is the intraday change. This is a number I'm really interested in that I don't really calculate that much. So this is from the current day's open, what would be 2% up, 3% up. This right here is to compensate for gaps. If we gap over the weekend or whatever, if we have some pre-market news or something like that gaps the market up or down, then I can calculate some things based off of, not taking that gap into account, because sometimes the market will gap, but then after the gap, it won't really move much, but it'll look like a huge move if you consider the previous day's close. So like, let's say the market gaps down 1.5% or something like that. Then I can look on this chart and see what's 1.5% down from that, and see if I can slide in a trade right there or something like that. So I got that idea from all of this. So your boy, of course, pulled in all the market data from the last 2 years. The reason being is, 2021 was a strong bull year and 2022 was a strong bear year. So it's not often that we get side to side years where one is strong bull, one is strong bear. And it just happens to be like basically on January 1, the market switched. Like the market peak was like January 1st or 2nd or something like that. So we have like back-to-back years of data that gives us both. So I can see the extremes on both sides, on the bull side and the bear side. So I did some maths and some formulas and all that kind of stuff, calculated the average change. It looks like the average deviation or the average up and down was 38 points for both years. This is all inclusive of both years, so I didn't separate the years. But the average move every day was about 38 points. But that's not good enough for our trading. That's nice to know, but that's not nice to place trades on, right? So did a little bit more number crunching over here with that data. And on this side, I've got how many days and what percentage of days the market moved by a certain percent. So you can see right here, the number of days out of the last 2 years, or the last 506 trading days, the market moved 2% 26 times, or 5.1% of all of the days. So 5% of the time, the market is moving 2%. So that is basically a 95 chance percent. If you're trading outside of 2% of the previous day's close, that you'll end up out of the money and win your trade. So that's good to know. That's good information, right? Now this number over here is just kind of showing like how large the difference is between the different lines right here. So this is just kind of, I wanted to see like diminishing returns, right? So like, is it that big a difference to try to go outside even further to like 2.5% or something like that? And it turns out it's not that big of a difference. There's only like a 3% difference between 95 and 97. So I just wanted to just plot that, whatever. I mean, I could see it, I could eyeball it, but still. So it to try to stretch it out further than 2%, it's up to each individual. Some people think 1.5% fine because you still got, 90% of your trades are going to win and you're going to stack a lot more profit that way. So it's just what your comfort level is, but this is cool to see. Same thing for the negative side. Basically 2% here as well. And you can see the market has been up more days than it's been down, but the severity of the down days is much higher when it's down. When it's down, it falls like a rock apparently, because you've got 5 days where the market fell more than 3.5%, and 2 days where it fell more than 4, where you've only got one of each on the up days, right? So that's pretty cool to see as well. And I kind of did it for the magnitude of the change as far as points. Same information. How many days was it above or below this? This is the up days. This is down days clearly. And I was kind of shocked to see we even had a down day of more than 170 points somewhere, which was like, wow. But we also had an up day of over 200 points as well, which was also like, wow. So interesting to see. Again, more up days than there are down days, but not by much. And I think the sweet spot for me would be to look at getting outside of the 80-point range on both sides. Maybe the 90-point range on the low side, but that's kind of far, right? That's pretty far. It's hard to get down there and still get paid. So what I wanted to do is look at the intraday change, because you have gaps. This is inclusive of gaps, right? So this doesn't really tell the whole story. So this is your intraday move. And this is a little bit more reasonable. So like once the market opens, can I get 60 points above where the market opened? If it's gapping up by, 10, 20 points or something like that, can I get 60 points above that? I don't know. It'd be interesting to see, but if I can, I'm going to win 95% of the time. Same thing on the low side. If the market gaps down by whatever points, can I get 70 points below that? I think this is a little bit more reasonable just because volatility. If it's going down, VIX is going to go up, which is going to increase premium. So it should be easier to look for this. But if I can find it, looking at 95% chance of winning all those trades based on the last 2 years, which I think are good examples to look at. And you can see all of the different price data right here going all the way back to 2021 down here. So that's what this is. So I'll check this out on Monday, kind of see if this is helpful or not. I hope it is. This right here is going to tell me what 2 times the expected move is and how wide the expected move is from a percent standpoint as well. So pretty cool. I don't know if it's going to be useful yet, but we'll see. Give it a couple of days to see if I use it or not. All right, so going to our trading rules. I think this is important to have laid out and to be able to reference, right? With my particular trading style this is pretty much everything that I could squeeze out of my head as far as how I trade, what I'm looking for, what I'm thinking about, all the rules, everything like that, what I'm going for. So first area right here, targets. So what I'm aiming for is 4% profit per day, at least 15% per week, 50% monthly, and 400% annually. Those are my targets. And all these are inclusive of, I know I'm going to lose sometimes. So I'm trying to keep this, pretty modest, but that's what I'm going for. 95% win rate is my target. And I'm going for about $20 per contract when I trade. Now the rules, very, very important. I want to be no closer ever than 40 points away from the market. Do I break that rule? Yes, but that's what I'm going for, right? It just depends on market conditions. That is what I hope to do. 2% away from the market. That's what I want to do as well. So I want to be 2% away from the market, no closer than 40 points, even if it's, 2%. Want to do 2 times the expected move. I want the stochastics to be crossing from an oversold or overbought position back into the mid range. So stochastics over here, if we're looking at the chart, and gotta blow this one up. Your swim is always wonky, man. Come on. Oh, Jesus. Click. So if I'm looking at this is the stochastics. A lot of people also use the RSI. The MACD is very popular as well, but I prefer the stochastics. I want it to be crossing into the middle zone past the blue line. I want it to be crossing in from the overbought side and in from the oversold side. I want it to cross that blue line. That's what I'm looking for. Okay. So we got that. Yeah. All right. So this is the mistake that I made on my last trading day. I'm looking for higher highs and higher lows, lower highs and lower lows as confirmation of a new trend forming. So what I mean by that, if we look at our last trading day, blow it up a little bit for you guys. I don't know why I'm using Thinkorswim. I should be using Trading View. But anyway, the mistake I made is I traded right here. This was not a confirmation. A confirmation probably really would have been this bar right here. So we had, if you discount or forget about the open, you had higher highs, higher lows, higher lows. Everything is just going higher, 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 higher. Then we had some consolidation or sideways action. It's not higher or lower. It's just sideways. A continuation up until this point. And then we got a little bit more consolidation until we got to this bar right here. This bar, I would say, is a convincing lower low. And then we got some lower highs as well right here, lower than all of this. That to me would actually be confirmation. So I should not have traded that call spread until we put this bar in right here. Even though the market continued up later, we would have been able to get enough buffer to comfortably ride this out, right? Or you can just not trade this side. It's clearly an up day. The internals were green all day. You can just leave this side alone if you want, right? That's more than viable. But that's what I mean by confirmation. If you look at this day right here, starts right here. It's kind of a sideways day, but you can say it's not really a trend here. I guess you could say this could be a trend break. It's kind of late in the day, but you see this right here, the low to break you can say this would be a low or this area would be a low. So you could say this is a lower low or a lower high. You could say all of these are a lower high right here, or you could say that this bar is a lower low. So you could say that. This green bar is clearly a higher high. So this could be a bar to sell a put against, but this is kind of like a nothing day, so it's kind of hard to really say. But this day's got some action, so you can see a clear uptrend right here. And you can see right here, we start to get some lower lows and lower highs right here on this break. So this would be a good setup to sell a put. You also combine that with the stochastics entering back into the middle zone right here. That's 2 points of evidence for you right there. So you've got that as well. So that's kind of what I mean by when I'm looking for higher highs, higher lows, all that kind of stuff. Support and resistance bump. So that's again talking about the pivot points. So pivot points, you have to be careful with pivot points because if they are closer than normal, they don't mean as much. Like this day, it just kind of blew past R3 there. So this is kind of, these pivot points are kind of scrunched up, but I'm looking for the pivot points to see if the market is respecting these pivot points. Today, they did not respect the pivot points at all, but a lot of times they do, especially if they're very wide. So I'm looking for bounces off of the pivot points. I'm looking for it to struggle against a pivot point or some point of support or resistance, like that long-term resistance that we kept playing with all last week that I drew. So if you look at this right here, I showed this in a previous video where this line came from. It came from the low in October, but the market really is respecting this point of support. It's bounced off of it 1, 2, 3, 4, 5, 6 times in like the last 3 days, right? So really, there's a lot of buyers down here that are ready to go ahead and scoop up the market. So I'm looking for that. If I see some trade opportunities down here, I'm likely to take a chance on it, assuming that all the other things line up as well. So we've got that rule. I do want to be outside of S2 and R2. S3 and R3 are preferred. So that's talking about the pivot points again. One thing I did do right with this particular trade, I put it above R3. Now the market ended up above R3, which is highly unusual. But again, the pivot points were very close together this day. They're not going to be as close the next day at all. But if I compare the two, you can see just how much closer the pivot points were that day than the next day, right? But still, I was able to get above R3, and that saved my butt. That saved me, right? So that's just another layer of safety. If I can get above R3, I'm likely to take that trade, but definitely I want to be outside of R2 and S2. S2 is right here, the second one, second green line. Okay. So also thinking about that. Trading time. I want to trade between 10 and 12:30. Reason is theta decay. Theta decay is a thing. It kicks in. It's a parabolic kind of thing where it starts slower in the early part of the day and then picks up as the day goes on. So after 12:30, around 1 o'clock, theta decay is really starting to kick in and squishing our options, taking away a lot of opportunities that otherwise would have been there earlier. As theta decay is really all about certainty. The more certain we are where the market is going to go, the more theta decay is going to kick in, taking away premium from the options, because the premium is to pay for that uncertainty, right? So the more certain things become, the less premium, the less those options are worth to sell. So we want to get traded enough early enough in the day where we still have some premium, where we can get some distance, some good distance away from the market. If it's like, 2 or 3 o'clock, you might not even be able to get outside of R2 at that point. It's too late, because it's clear that the market is going to end up somewhere around here by that point. So nobody's going to pay you to sell an option down here in no man's land when there's absolutely zero chance that the market is going to get down here. So this side of the day right here, we want to avoid all that morning stuff, right? We want to avoid all of that, and then wait for the market to kind of settle in and find what it wants to do for the day, and then go trade after that. All right. Delta. I want to be between 5 and 10 delta. So I don't really talk about it that much, because expected move pretty much takes care of that for me. But to see your delta, You just want to have single options on your screen, and then you can see your delta right here in this column. And I typically am going to be trading around 5 to 10 delta, something like right here. This area right here, probably closer to 5 delta because I'm not that aggressive. So probably closer to 5 delta. But like I said, the expected move takes care of that for me. It's usually a pretty close corollary. But for those delta traders out there, that's what I'm looking for. And I also want to look at the internals to try to see if I can pick up some inkling about the direction of the market, what it's going to do when it's turning. If the market is getting worse, that can be really important because sometimes when you're in a really bearish day and you trade a put, the market can just deteriorate, and drop and drop and drop until it goes into like this black hole mode where I've seen the market drop 50 points in like the last maybe 15 minutes and enough to destroy any trade that you put on that's a put, right? That you can't get far enough away from the market in those situations. And the only way that you're really going to see that coming outside of intuition is maybe looking at the internals just to see just how bearish they are. Like if every position in the SPX is negative and the volume line is just going into the toilet and the put call ratio is just going through the roof, or just everybody's suddenly buying puts and all this kind of stuff, that's Richter scale stuff. That's giving you like, hey, yeah, this ain't getting better, so that might inform you to go ahead and close out that put and stack up on calls or something like that. Some of those days that where the market was down, minus 4%, 3.5%, all that kind of stuff. Those are serious down days. Like this stuff right here, 100 plus points. Those are some seriously down days. And I can almost guarantee you, if I look at these days, the market, the last like 15 minutes of the market just looks like it's pointing straight down. Like it probably did half of this day in the last hour right here, right? And I've traded on days like that, and it's just sad. It hurts, and it's just like, oh my God, I'm so glad I got out of the way. So the internals can help you maybe pick up on some of that stuff. So you want to look at that. Risk to be aware of and to mitigate. News overpowers everything. It don't matter what the market is doing. If some news comes out that, I don't know, Enron is going out of business or whatever, it's the market's going to follow that, right? News is the biggest market mover, period. Okay. FOMC is literally the biggest market mover. When Jerome Powell speaks, I call him Jesus Price, because people hang on every hair in that man's nose as far as what he's saying, what he might mean, what he might be thinking, what he's not saying by saying this and all this kind of stuff. He'll blow up a trade effortlessly. Like you can't convince me that this man isn't telling one of his cousins somewhere to trade this or that ahead of his speech because he knows that he's going to twinkle his nose left, and the media is going to be like, "Oh my God, he twinkled his nose left. That means that interest rates are going to this or that." So FOMC, you have to know when the FOMC days are. That means meeting minutes. That means getting your economic calendar up. That means whatever you got to do, know where this is coming. Okay. We just had one of these last week. All right. So be careful about that. Economic reports, same thing. You got to know when the unemployment rate's coming out. You got to know when the CPI is coming out, the inflation data. When energy is a big factor, you got to know when the natural gas report is coming out, or the oil, or the OPEC meetings. are coming out when oil is big and when the market's paying attention to that. They're not right now. But when they are, you got to know when that stuff is coming out because the market's going to move based on that stuff. So get you a good economic calendar that you can just keep up and have with you so you can know what's what. Overnight trades. This is a risk because you can't do anything about it. The market will gap up or down on you, and there's nothing that you can do. You can't react because the market just opens up where it's going to open up. So you have to be very careful about trading overnight. That is a risk. Gaps, same kind of thing. Gaps don't normally happen when the market is open, but overnight, over the weekend, the market can gap, and you have to be careful about gap fill, right? So the market has a strong affinity to fill gaps when they happen, even if the market goes back up. So just like it did the last trading day, I think. So it gapped up and it tried to, I think it actually did fill that gap and then it continued right back up where it came from. So the market does not like gaps, does not like them. So you have to be careful about that, especially, if you see the market's up 50 points on the open, don't sell a put, right? Wait, okay? Wait for it, all right? Or if the market gaps down, 60 points and it's just way down here and it's like the market's all negative, just wait for the gap wait to see what the market's going to do. Don't try to trade on the gap because it could stay down here, then gap back up. Who knows what it's going to do? But it gets very unpredictable with gaps. So you just have to watch those as well. Extreme VIX. So when I say extreme VIX, I'm talking about like VIX over like 25 or maybe even over 30. Let's see look at what some extreme VIX is. Come on, buddy. Let's look at the daily chart here. Okay, so right now the VIX is at the 21-ish area. And, the VIX spends some time, a good amount of time over 30 the last couple months. And I remember back in 08, the VIX was hitting, I don't know, well past 100. I think it hit some really stupid numbers back in 08. So the VIX can launch into space if it wants to. Now, the conventional thinking is that high VIX equals high premium, and it does, but there's a reason why that premium is high. Just because the VIX can keep going up, right? Like the market is like like a moody teenager, right? So like once it starts to get into a funk and fear starts to take hold and it starts to get contagious. You can easily slip into a flash crash and blow out any put trade, right? Any sold put, it can blow it wide open out the door where there's nothing that you can do. So you have to be careful about when the VIX is very, very high, because it could spike. And if it spikes, it's going to destroy every trade that's out there as far as selling puts. So the premiums are going to be very juicy, but you can't get far enough away from the market if it decides to pull one of those flash crashes and it'll blow up whatever trade is there. So got to watch out for that. 20 VIX, cool. 25 VIX, okay. 30 VIX, let's probably stick to calls at that point, So watch out for that volatility stuff. All right. Self-patience. So this is something that I personally struggle with, is trying to be patient. Sometimes I'm just eager to get in the market because I got other stuff to do. I just want to get it out of the way, put in a trade so I can do my other stuff, or whatever. A setup looks like I think the one thing I really struggle with more than anything is a setup looks like it's going to be good, but it's not good yet. Just like that last trade that I did where it looked like the stochastics was about to roll over, looked like the market was going to roll over in a couple bars, but it had not confirmed yet. So I'm not a very patient trader. I'm usually not a very patient person in general. But you have to be if you want to play this game. And, the market will teach you to be patient if you're not, again and again, relentlessly. So self-patience is a risk for me. So greed is usually not, thank goodness. But if it is a risk for you, I would put that on your list of risks because greed can kill you too. Pressure to perform. So we talk about all these projections and I want, 4% a week, 15% a month and all this kind of stuff. And sometimes the market just doesn't give you that. And that pressure to perform, it's not really greed. It's more like, I'm trying to hit these numbers. I got bills to pay. I got targets to hit. If I don't, get this particular trade off, I'm going to be behind, all that kind of stuff. And sometimes the market just doesn't give you what you want. It's just not there, right? So you have to actively know, just don't, it's okay not to trade. It's okay, not to hit that target. It's okay. And you got a lot of pressure out there too, because if you're watching my YouTube videos, I'm guarantee you watching other YouTube videos. And if you see the videos that I see, you've got people bragging all the time. Look how much money I made. I made 2,000%. I made, $1,000 in 30 nanoseconds and this and that. And it's just like if they can do it, why can't I do it? Right. And sometimes it's just not there. And I guarantee you that they aren't doing it either. Sometimes you get lucky and you're able to film it and you're able to tell a story about it and you're able to sell courses based on that and all that kind of stuff. But sometimes it just ain't there, Chief. It just ain't there, right? And you have to have the wisdom to know that, today just ain't the day. It don't feel right. It don't seem right. Don't smell right. So it's better to just not trade and miss an opportunity and not hit a target versus forcing a trade to try to, get that next zero in, or, you're so close to your first $10,000 or something like that. And you're at like $999.9. One more dollar is going to push you over the edge. And that $1 is what's going to be the thing that blows your account up. Right. I've seen it, seen it and done it. So the pressure to perform, you have to watch that you're not going to hit your targets all the time. But all the at bats that you get, the math is going to work itself out. The percentages are going to work themselves out over time, but you need a lot of at bats for it all to add together and to average out. But it's not going to be there every day. That's why I've gone very conservative with these numbers. These are super conservative numbers. Like, really, with compounding, this could easily be 2,000%, right? But I don't want that in my head. I don't want that in my head. So work, right? I've got 2 jobs basically. Now I got 3 with this YouTube thing. And trying to take care of family and home and all that kind of stuff. So this can be a risk because work can intervene at any time. So I try to trade in such a way that I am free to do whatever. That's one reason why I trade this particular system, because it gives me probably the most freedom that I can have to step away at any point where I don't have to be locked in to a computer for any set period of time. That's why I set alerts. That's why I only do 1 trade per day or 2 trades per day on each side of the market, whatever, so that I only have one thing to really worry about and I don't have to worry about it much. Like I know there was a discussion in a chat room about, a trader that does multiple trades on the SPX throughout the day. And that's fine and all, But in the argument there was like diversification, and I get it. But I mean, it's just more to worry about because now you have multiple spots and diminishing kind of spots because theta decay. Like you have a wide open trade earlier on in the day, but if you trade, 5 more times or whatever it is, you're placing your last trade, maybe with like an hour left to go, super close to the market because that's all the market's giving you, and theta's decayed. So now you're like 15 points away from where the market is. So you got to worry about that trade, and you got to worry about the other trade, that you might have gotten closer earlier or something like that, and the market did whatever. It's just a lot to worry about, and a lot to kind of mentally keep up with when you got a lot of other stuff going on. So I just do one trade on each side of the market per day. That's it, and then that frees me up mentally and time wise to do other stuff like make these videos and do my actual job and stuff like that. So that could be a risk. So you want to mitigate that as well. Risk management. I set an alert 20 points away from the mark, or I'm sorry, from my short strikes so that I can go do other stuff until I get that alert. 20 points gives me enough time and enough distance to make a decision without having to feel rushed. I can kind of consider, I can set up some different, I can go and set up some all different trades, kind of see what that's going to look like, and then make a decision as far as what I want to do. So alert, that's a big thing. I do not set stops on in the market. The reason I don't is because of the risk of a rogue print. And that is super, super annoying. That's happened to me. And because of that, I don't think I'll ever use stops again unless I just have no choice, because I was in a great trade. The trade was green. The market was nowhere near my particular stop at all. And I got stopped out anyway just because of a rogue print. Like the market just printed a wild number that was beyond my stop, and the market doesn't, I mean, the exchange or whatever doesn't know. It just sees numbers, right? It's a robot. So it stopped me out anyway, even though I was in absolutely no danger of losing the trade, lost money, potential money. Even though I was in profit, thank goodness, I could have just as easily been at a small loss at that point, and it took a loss for no reason. So I don't set stop losses for that reason, but I will set alerts, and I can, if I have to, I'll just drop in a market sell and be done with it. But I don't use market orders either. That's another reason why I set this alert, so that I can have time to set limit orders. If you're setting a market order, that's like break glass emergency. So try not to set market orders, limit orders at all times if possible. Let's see. Oh yeah. Hold on. Oh yeah. So if you're in a position where you need to roll, then you want to roll outside of the next day's expected move. If you cannot do that, you're probably going to want to close out the trade. It's probably better to just close the trade and take that loss than try to roll it. It's better to close the trade and then set up fresh for the next day versus trying to roll just to get right next to the market for the next day, because then you have gap risk, you have overnight risk, news risk, all that kind of stuff that you're taking on while being way closer to the market. So sometimes it's better to just take the L and reposition entirely than try to salvage a crap trade. So if you are rolling and you see your roll is inside that next day's expected move, so if I'm rolling from January 9th to 10th and I see I'm within 50 points of where the market is, because the expected move is 50 points. So if I'm like 40 points away or 30 points away, whatever, it's probably better to just go ahead and close out that trade and start fresh. Another risk management move is if you are in trouble on one side of the market, then you can move up or just place a trade on the untested side. So if I am in the SPX here and I am getting, if the SPX is knocking on my door on the put side, I can go ahead and place a trade on the call side to bring in some income to help mitigate the loss. It's not going to fully wash out the loss, but help mitigate some of the loss that I'm taking on the put side by selling on the call side. And if you have more than 25,000 in your account and the market continues to move against you on the put side, you could just keep rolling down that call, rolling down that call, rolling down that call, collecting credit. If you don't have to worry about the pattern day trader rule. But if you do, you could just go ahead and place a trade on the call side and just collect that one-time credit to help mitigate some of those losses. Like the trade that I was in trouble with right here, if I wasn't worried about the pattern day trader rule, what I could have done, my put was well out of danger. My put was way down here. So what I could have done is I could have placed my put and rolled the put up on the same day and collected more credit. Maybe roll it up here, maybe roll it up here, maybe roll it up here. Now, depending on how the day shapes up, the rest of this rule may not apply, like it wouldn't apply to the last trading day, but you want to try to move up your put all the way up into the open of the day. Now, like I said, it didn't apply here because the day was so far in already. So like we're talking about the last hour, right? So the open was like way down here. My put wouldn't have been in danger anywhere past any of this stuff, you know. But I did say either past the open or major support and resistance. So I could have easily found a major support area to put my put below. It could have been these Bollinger Bands right here. I could have used a trend line or something like that, or I could have used this swing low right here as major support and just rolled my put up to there to collect all of that credit to help finance some of this loss that I might have taken right here to help me out a little bit. Because again, you have to remember only one side is going to lose. It's either going to be the put or the call, but not both. So if my call is in trouble and the market keeps banging on my call, that means a put should be safe, ostensibly, right? Of course, the market can reverse, but that's why you don't want to get too close, right? You don't want to pinch yourself into a position where the market can just whipsaw you and lose on either side. Who knows what side? But that is a way to mitigate some risk right there. I didn't write this, but if let's say my call was, I don't know, right here, 38.85 or something like that. And the market is just freight train, choo choo, going to blow me out. And I see it. I see it's going to blow me out. If you have the capital, one thing that you can do is you can close your short strike on your call, and that's going to leave you with the long call. And the long call is going to gain very rapidly with the market going up like this. If you once you trade a spread, just one day look at your long strike on the call. If the market starts to go against you a little bit, just see how much and how fast that it's gaining value, right? Without the short strike there holding it back, it's going to gain value really, really fast if it's getting blown out. So a technique, and it's hard to do sometimes because the market can be so volatile, but if you get it right, I've done it before, and it works. Close your short strike, let the long call take over, let the long call gain as much value as you feel comfortable with, and then close out the long call next. That it could potentially gain back all your losses because it's that powerful, it's that potent. If the market is just shooting straight up on you, straight into, your position, you say, okay, well, take this long call then. Since you want to go up here, let's go up then. You want to do that only if you can see yourself about to get blown out, right? You don't want to sell your short strike just off of a tiny move, or if the market is just like piddling along there, moving up a little bit or something like that. Long positions need the market to really make a powerful move to make money in a short period of time. So it has to be like this, like straight up in the air. But it works. It does. This is important for small accounts right here. So if you see yourself getting in a little bit of a trouble on one side and you've got a condor on, close the untested side if you know that you might roll. So if you're, $500 account size like me, definitely do not have extra collateral. I cannot support more trades than I have on right now, which means if I try to roll and I've got a condor on both sides, the market TD is gonna laugh at me. It's gonna say, no, you can't do that. You've already maxed out all of your trades. You got to free up some money or bring some money in. So the only thing I can do is close out one side, and that frees me up to be able to roll and reposition the tested side of my trade. You have to do that. You want to do that early, because if I'm way down here, my put's way down here and I'm starting to get tested up here, well, guess what? I can't get rid of this put. I'm trapped because the puts, all the strikes on my put are going to be at zero. Once they go to zero, that means there's no market for them. Nobody's there to buy them back. So even though this trade is doing so well and I want to collect the money and get out of it, I can't. I'm stuck. So you have to get out of it early enough while there's still a market, while there's still a bid somewhere on my strikes where I can close them out. So that's a danger that you have to be aware of. And you won't, if I didn't tell you, you would never know. Nobody on YouTube that I've ever seen makes that point. I've never seen a video out of all the people that I watch tell anybody that. So you're getting some value that you're not going to get anywhere else with that. Okay. Especially if you have a small account. Close out the untested side of your strike. The first thing that you think when you're about to get in trouble, if you even sniff a little bit of trouble, close out the other side and collect that money. Now, it will count against your day trading, but you got to do what you got to do. I mean, this is the hood, right? We got to do what we got to do. We got to make grilled cheese with the iron, right? So do what you got to do. All right. Why SPX? Why is it SPX 0 DTE? Why is all the buzz? Well, this is why. You got diversification inherent in the instrument. This is why we're picking SPX specifically above everything else out there. Diversification is inherent within the SPX because the SPX is made up of 500 different stocks. So we don't have to go out there and trade Apple. We don't have to go out there and also trade Google and trade Microsoft and trade Tesla and whatever all together just to get a good amount of diversification so that, one day we don't wake up and Elon Musk is found on top of a telephone pole in his underwear and Tesla shoots down 50% before the open or something like that. And I'm not joking with some of that too. There was like a story about, I think it's like the CFO or something of Tyson Foods was found like drunk in a drunken stupor in somebody else's bed, wouldn't get out and all this kind of crazy stuff. Like if your stock wakes up to that story, you're down 30% and have no way of, doing anything about it. Well, you don't have to worry about the SPX, right? It takes big news to move the SPX. So there's no one single person, save Jerome Powell or President Biden, that's really going to move the SPX. And that's if something happens to Jerome Powell, that's not going to move the SPX. He's just going to get replaced, right? The only person that something can happen to him would probably be President Biden, I guess. Obviously, I hope nothing happens to him. I'm just saying, like, as far as moving the market with and something crazy happening, it's not going to happen to the SPX. Scalability. It's the largest options market, the biggest one. So you can make your whole entire career starting from $500 on up to however big that you want to grow, exclusively trading the SPX. And that has an advantage of over time, you get to know and get a lot of experience with just this one instrument. You don't need anything else. You can trade thousands of contracts on the SPX. I've seen some absolute monster trades on the SPX as far as options contracts are concerned. So as big as you want to trade, the SPX can handle it. So you'll be able to just use this one instrument, get to know the instrument over time, know how it moves, know its traits, know all that kind of stuff, get all that experience, and then have your entire career just in this one instrument if you want to. So you don't have to ever switch out because it can't handle the amount of contracts you want to do or whatever. You can just do everything on the SPX. You can scale. Low manipulation. So you're not going to have like a market maker, game the SPX to, shake out the shorts or, do all this kind of stuff. It's the SPX. It's massive. It's a whale. It is the whale. It's the blue whale. So there is no market maker or entity except for Jesus Price that I can think of that can try to even manipulate this market, right? This market is what it is. It's the GOAT, right? So you're not gonna have to worry about manipulation and all that kind of stuff. It's the market. There's no earnings announcements. So you don't have to worry about every quarter getting out of your stuff to wait and see what the earnings report is going to do to the SPX because there is no earnings to worry about. There's just FOMC. And FOMC won't always be an issue, or as I'll say, as big an issue. It's just right now with interest rates being like the big mover. But you don't have to worry about an earnings report. You don't have to worry about a bad earnings report ripping down and doing all this kind of crazy stuff and gapping down 30% or gapping up 20% like Google used to do, all that kind of stuff. You can just trade it. You don't have to worry about that. No assignment. This is massive stuff. So with spreads, you can get into a situation, even if you're trading a spread where the market ends up between your strikes and you get assigned stock or you get assigned short stock, which is worse, I think. And you wake up one day and your account is showing like negative $100,000 or something crazy like that because you got assigned stock and you like sitting there panicking like, oh my God, what do I do? What do I do? What do I do? You won't have to worry about none of that with the SPX because it's a European style index option. There is no SPX stock to trade, so you can't get assigned anything. So that takes that worry off of the table, something you'll never have to worry about. 5-day expirations. This is humongous. It didn't used to be like this. This is new, very new. I think as of like 21 or 22 or something like that. It used to be 3 before that, which was great. And before that, it used to be weekly. And then before that, it used to be monthly. But below, I'm going to talk about why we do 0 TE. So I'll expand on why this is so great at that time. Tax advantages. So when you trade index options, you're going to get a tax break. I can never remember the ratio. I think it's 40% short term, 60% long term, but it could be the other way. But anyway, you're going to be taxed at the capital gains rate on either 40 or 60% of your profit on when you trade index options. Unlike stock, where if you trade 0 TE or anything close to options that expire less than a year, then you're going to be taxed at the full short-term rate, just like your work is taxed. Your work wages are taxed. But here, you're going to get a tax break. It ends up being like, I don't know, depending on your tax bracket, it ends up being like 20 or 30% less in taxes to trade the SPX than it does the SPY. So, especially for you bigwigs out there, that can make a big difference, a huge difference, right? So, tax advantages. You get standard strikes. So, this is what puts SPX above the NDX or the NASDAQ. So, SPX, you're going to get a huge amount of strikes, where with other markets, you don't. So you can see this is like 100 strikes wide, and they're all 5 apart, 5 strikes apart, 5 strikes apart. I can go 200 out, and what's that? It's even numbers. It's like these are 50 points apart. Then it's 25 points apart. Come on, man, move. Then we go back to 5 apart. So the strikes are all pretty much divisible by 5 for the most part. If I pull up the NDX, it's going to have some weird stuff. It's going to have some weird strikes that if you're trying to do an iron condor, for example, and you want your iron condor to be 50 points on either side, well, the NDX, let me see if I can just show. The NDX is going to have some weird differences in their strikes, which can make it difficult to trade, especially if you're trading further out like I do. So let me see, 100 or something. And I'm gonna swap this to vertical so we can just have a vertical difference. So like right here, if I want to trade this particular strike right here, you can see this one is 25 points apart right here, 25 points apart, 25. So it goes from like 5 or 5 apart, and then all of a sudden it changes to like 25. So like if you're at this break point right here, and you go to the put side is going to be completely different with the same distance away from the market. So this is 10. This is 10 points apart. There were none, I don't think, up here that were 10 apart. Well, 290. Yeah, there are, but up here it just goes from 5 to 25. So it gets weird with the NDX, right? And that's something that I found out when I was trying the NDX instead of the SPX. You have to be careful about that because you want the width of your strikes for iron condors to be the same. Okay, so you don't want a 25 wide on the bottom and a 10 wide on the top because you're not being capital efficient that way. You're leaving some money on the table. You're not taking advantage of all your capital, and it just gets weird, right? With the SPX, you really don't have to worry about that because they don't start widening out the contracts until way, way far out. All right. But the NDX, they start widening their contracts at pretty close in. So you're going to get some uneven iron condors with that. And it's kind of funky. You don't want to deal with that. So you got standard strikes. The IWM, I haven't really traded the IWM. I might take a stab at it here too, but they have one, their strikes are 1 point apart. So that could also be, but I don't know how they are as far as like how wide their strikes are. And it also doesn't look like they have as many expirations on that. So the SPX still wins again anyway. Tight spreads. So this is talking about the bid ask spread. You're not really going to get too much tighter than the SPX. SPX spreads as far as your bid and ask for your options markets, very tight. So it's the weekend right now, so it's not going to seem as tight, probably. But if you see 35 cents here as being the middle of the bid ask spread, you're very likely to get that 35 cents. Where there's some markets, a lot of options markets, unless you're talking about big markets like Apple and Google and stuff like that, a lot of option markets, they have super, super wide bid ask spreads that don't get the middle filled. Like you're going to have to go all the way down to the bid to sell that particular option, where the ask might say like $1, but the bid says like 15 cents or something crazy. But this, you're more likely to get that middle market price than anywhere else, except for like an Apple or Google or something. So another worry that this is just another thing that you have to think about and process and worry about. It's an automatic exchange. So this has to deal with the speed of your fills and especially your cancels. So you can get into a situation like if you're in a small options market where you put in an order and then the market shifts on you and you want to cancel your order and put in something else. Well, you can hit the cancel button and the thing will be just like, wait. Like your order will just say, wait, stop. And you're like, okay, I hit the cancel button. I keep hitting the cancel button. Nothing's happening. Cancel, 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 cancel. And it's just sitting there looking at you. Nah, wait. And that's because there's a person in the actual exchange that has to manually cancel your order. And that sucks. Like you just want to cancel it and get out. Well, you could do that with the SPX up until, at least with Thinkorswim, a certain order size, a certain contract size. I forget what it is, but it's way up there. You won't have to worry about that for a long time. But it's way up there, but it's annoying. And I don't understand why they do that. I would think I understand from a labor side, but they should just make it all automatic to me and not have to worry about that because of speed. But they switch you over to a manual person, a live person that handles your orders at a certain contract size. But with the SPX, it's mostly automatic unless you're trading really big. It's mostly automatic. So when you hit cancel, it's canceled. When you place an order, the order is placed. So it's just another thing that you don't really have to worry about, that you don't even know that you didn't have to worry about it, right? Another convenience. So that's why we do the SPX specifically, but why do we do 0 TTE? Why don't we do 30-day trades or 365-day trades like all year or something like that, where we can get super far away from the market and all this kind of stuff? Well, it's really because of your profitability over time. 0 DTE trades are going to be the most profitable dollar for dollar trades that you can do per unit of time. So I got this table here where I plotted different trades, different time trades against each other. And what I did to make it apples to apples as best I could is I traded the same expected move for all of the trades. So I've got that number here. I've got a 0 DTE trade. It's technically a 2-day trade, but it's because of the weekend. So this is the next day that comes up in the next trading day. And this is one day after that. This is 5 days out, 13, 30, and 356 days is the closest I could do for a year. Now there's 220 trading days in a year, but this is calendar days. Okay. So this is inclusive of weekends and everything like that. So the expected move on the next zero DTE was 35 points. Then you have 50 points, 94 points, 124, 180, 780 for the year as far as the expected move for the market. At that expected move, I was able to get a $90 credit for the 0, 105 for the 1, 105, 190, and 113 for the year-long one. Now, if we break that down to how much you're going to make per day, then obviously every trading day we're going to be able to make $90, right? Because we're going to be able to make $90 the today, tomorrow, the next day, the next day, the next day, all else being equal. If I come out here to the 1 day, well, it really drops. So instead of making $90 or $80 or $70, we're down to $52 per day because we're only getting in one trade every other day. At this point, we are getting a little bit further away from the market, but not that much. Then we have overnight risk and gap risk and all that kind of stuff. We trade once a week, then we're looking at $21 per day with the same level of risk if you measure that risk by the expected move. And if we trade once every 2 weeks, that drops all the way down to about $7-8 per day on average that we're making once we average everything out. $3 a day if we trade once a month at the same expected move. And then for the year, all the way down to 32 cents per day if we average out over a 220-day trading year. Now, if we annualize these numbers as far as a percentage and as far as a dollar amount, you can see the results. While this is still amazing, which is crazy that this is still amazing, you compare 13% to 3,900%, it's absolutely no contest. Now, you can make an argument for larger accounts because you don't really need to make as much dollar per dollar on larger accounts as you do smaller accounts to grow them, but you absolutely need this to grow your small account. Now, this has an advantage if you've got, let's say you've got $2-3 million in the bank, $5 million in the bank. You want to make 13% on that and make a sweet trade that the market won't even touch or whatever. You can do that, right? Just sell like a yearly put, get your 13-14%, beat the market, and call it a year. Right? You can absolutely do that. But when we're trying to grow our teeny tiny account, yeah, we need this right here. We don't need to be making $69 a year. We need to be making $19,000 a year. All right, or at least shooting for that as safe as we can. The risk is still going to be, pretty close to the same because this is based on the expected move. This is what the market is expected to move. And you got similar risk, but the returns are way different. So every day that you can trade an expiration, just because of the nature of how theta decay works, every day that you can trade an expiration or closer to an expiration is going to be better for you. And that's what puts SPX above trading something like Apple or Tesla options, or even IWM or whatever options are out there. If they don't have a 5-day expiration market, then you're essentially giving up profit. You're essentially giving up profit. So go out there and compare trading a 0 DTE starting on Monday, 0 DTE trades in the SPX, add up all the trading wins for a week, and then compare that to how much you can possibly make on Apple for the same level of risk. or Tesla, whatever, choose your market. I don't care who it is. The only thing that can come close is the NDX. That's it. And maybe the SPY. I don't know if they got 5 trading days, but if they do, that's the only thing that can come close. But then you still might as well do the SPX unless you got a really, really small account or something. But there, I just want to show you guys that. I know it's a long video, but I had a lot to go through. I hope this brings some value to a lot of you to help you kind of get inside my head, understand what I'm thinking about. And I know I've got more to learn. There's other people that do it slightly differently, look at slightly different things, all of that kind of stuff. That's totally fine. It's a big market. There's lots of ways to make money. There's always another side to the trade. And somebody's going to make the money. One side or the other of a trade is going to make money. Okay, regardless of what trade it is, somebody's going to walk away with a profit. All right. So I don't really judge anybody else that much. I do ask questions. I do get confused by why people do stuff. And I will ask, what is that? But, and not everything is for me. But, this is what I'm going with until I find something better. All right. So thank you for your attention. Hope this video wasn't too long. Please do all your social media stuff, like, share, subscribe, all that kind of stuff. Get me to 1,000 subs. 1,000 subs is what I'm looking for. Because that'll be really nice. And I appreciate all my new subscribers that I've gotten. The channel is growing. Even though it doesn't feel like it, but that's how small things start, right? I bet you when I post that video of $500 turns into, I don't know, $5,000, the subscriber rate will really climb, right? So y'all will be here first to see it live while they're kind of watching replays. So thank you for your attention, and we'll see you Monday to see what's up. All right, guys, out.